Good afternoon, folks. The Money Pit Group, Robert Quigley speaking. Today we're going to talk about the difference between trading and investing. Should be a short video, but let's get started. There are two different ways to earn money from the stock market. Short-term trend following and more long-term investing. Personally, I've done both. I have made tons of money scalping and day trading, which basically means picking directional moves in the market at any given time of the day, although mornings are the best. And I've also traded futures on a short-term basis. Basically, you're doing the same thing. I've traded commodities on a short-term basis, essentially picking, figuring out which direction the stock is going. Is it going up? Is it going down? Very short-term micro trends. To give you an example of this kind of trading, Jim Simmons, the founder of the Renaissance Fund, has made billions, $100 billion from this method. And his average trade, according to many sources across the internet, was 8 seconds. Very short-term trading. Of course, what's the difference between 11 and 8 seconds? Not too much, but I think the actual number is 8 seconds. Investing, on the other hand, you can hold positions for months, for quarters, for years, and in the case of Warren Buffett, you never sell. You hold them for life. So what's the difference between these two? And what we're going to do is we're going to use an example of a stock that was once upon a time a trading stock and has turned itself into an investing stock. The stock that I'm using is called Sundial Growers. The reason why I'm using Sundial Growers is because I hold a huge position in this stock, and I know an awful lot about the technicals and the fundamentals, the trading history, and the future potential of Sundial Growers. So essentially, what is Sundial Growers? Sundial Growers is a pot stock, cannabis of course, from Canada. They're based in Alberta, Canada, and they have turned themselves into Canada's largest producer and retailer of cannabis, as well as Canada's largest retailer of alcohol products. But it wasn't always like this. Sundial came on my radar screen in January of 2020, and that's when the new CEO took over the company. The guy's name is Zachary George, and he's done a fantastic job. At that time, Sundial was pretty much a failing company. It was about to file bankruptcy. It was not making enough sales. Its expenses were over the top. Everything you could imagine in terms of a company was going wrong for Sundial. And they had problems with product. The competition in the market was fierce. Everybody, their uncle and their dog, wanted to get into the cannabis business, and there are thousands of companies at that time in Canadian cannabis. Of course, Canada had only legalized cannabis on a recreational basis a couple of years before that. So, like all gold rushes, everybody thought that this was their time to shine in the sun, so to speak. So that was then, and there's a whole group of traders on the Wall Street Bets channel on Reddit. A lot of meme stock traders, basically huge numbers of folks who got free stimulus money, who tried their hand in the stock market, and at that time, some very clever, and some might say devious, traders decided that Sundial was perfect for a pump and dump scheme. Everyone was hot on pot stocks, and Sundial was so cheap they were able to buy up millions of shares literally for 20 cents a piece. And then, of course, once you own that many shares at such a low price, we're talking, in that sort of frenzied crowd with a lot of speculation and free money, people were easily fooled. So, of course, they put out a bunch of false information. The huge meme stock trading crowd jumped in, pushed the price up. At one point, it had reached $4.50, almost $5, and of course they dumped their shares and they pocketed millions. Legally, absolutely, but of course they got away with it because it is somewhat hard to prosecute these people. But nevertheless, that was the beginning of Sundial growers. So there was really no investment thesis. There was no reason to keep Sundial at that time for a long-term investment, because everything, all the fundamentals were very negative. It was not profitable. It was spending way more money than it was making, and had a prospect of making. So that was the essential problem at that moment in time, is Sundial was just a dead company. However, Zachary George and his new management team over at Sundial, they had experience in the stock market, and they had prepared themselves in time for a new share listing. And when they saw the share price spike up, they were able to quickly implement a new share issue. Now, the paperwork had already been done in advance, and they had no way of knowing that there was going to be a spike, or that there was going to be the stimulus or a meme crowd. They had already planned to improve their company by raising more capital. So essentially they had the paperwork done, and the whole point was when they were going to issue new shares. So the timing presented itself. And during that 2020 spike, they were and actually I believe the spike occurred in 2021, to be exact. All the groundwork was laid in terms of turning the company around in 2020, and I think it was March 2021, if I remember correctly, maybe February 2021, that the stock price spiked. They were able to issue shares, and they issued 1.2 billion shares, and essentially they were able to raise something on the order of about $1.5 billion, and they used that money to pay down their debt. They acquired several other companies. One company was called Spirit Leaf. Another company was called Alcanna, which was Canada's largest alcohol business. Which owned Nova Cannabis. So Sundial wound up at the end of the day with 360 plus retail stores, no debt, and a ton of cash in the bank, and a profitable business. Now this is interesting. So we had a stock that started out, maybe you could trade it, maybe you could catch the spike. It was very short term. It didn't really have a future. You were just trying to make money off of the price action of the stock. If you thought it was going up, you'd go long. Once it went up, because you knew there were no fundamentals, you would short this baby and it would come back down. And on a very short term trend following basis, people were making money. But then during 2021, Sundial raised a mountain of money. They turned their business around. They revamped the personnel. They picked up profitable businesses. And all of a sudden, fundamentally, it's a totally different company. Now, at this point in time, we have an interesting dichotomy in Sundial. One of them, of course, is 95% of the shares are owned by retail traders. Retail traders, by definition, tend to be very short-term traders. They're news-driven traders, and they're really not in it for the long term. Once you get stocks that are well-established and they've got great fundamentals, they wind up being majority owned by institutions. Sometimes as much as 75 to 80% owned by institutions. Sundial's got the fundamentals, but they are still owned predominantly by retail traders. So that's the problem, because the stock price is extremely volatile. Retail traders have a short-term outlook. They want to grab their profits as quickly as possible and go on to the next stage of life. A totally different debate, but that's the way it is. Whereas institutional investors, they're there for 6 months, multiple years. They're looking for much bigger moves in the market. Now, at this point, I'll just say I own 200,000 shares of Sundial. In my family office, we own 200,000 shares of Sundial, and we got them really cheap. I mean, we're talking about in the pennies. So once we finally cash out of this position, we're expecting to pocket enough to, we could easily buy a really, really nice house in cash. Not that we need another house, but I'm just kind of putting it in proportion. And that's an investment framework. So we're in it for the long term. Let's see. So essentially, we've gone from a transition, a trading stock, to an investment stock. Let's talk a little bit about the companies that Sundial acquired. Alcanna, which is Canada's largest alcohol retailer, before the acquisition, Alcanna traded between $5 and $6. The company that they own the majority share in, which now Sundial does, it's like 63%. They traded in the $2.50–3 range, maybe $3.25 range. So now this is an interesting point because of the shareholding characteristics of Sundial, basically a horde, an army of short-term retail traders owning the stock. Sundial currently trades for 47 cents. Ridiculous number. Won't be here long because earnings are going to be coming out in a couple of weeks, and this is going to be the end of a low stock price. But nevertheless, if you look at the fundamentals, they went out and bought companies that had stock prices 10 times higher than its current stock price. And then you're asking yourself, wow, why wouldn't Sundial, have the same stock price? I mean, it makes no sense at all. I mean, the fundamentals of Sundial have only gotten better. And one could say, well, you've just traded, one fundamental picture of its stock trading for $5 to $6 and put it in another company. Why isn't that company's stock trading for $5 to $6? So as you can see, the disparity is without substantive reason. I mean, of course, as we know, it's because of the short-term retail traders versus the longer-term institutional traders. But that is the key. That is the picture that we're looking at. So, what are some of the price targets? Well, like I just said, $5 to $6 is the most likely near-term fair market value. And then when you can consider the other cannabis companies in both Canada and North America, if you take their stock prices, even if you did a simple average, there are about 25 of them. So if you added them all up and divided by 25 and assumed that everything was more or less equal, which is not, because Sundial is the only profitable cannabis stock in North America. But putting that aside, if you were just simply to do a simple math calculation, you would wind up with a stock price of about $8.50 or $9, and that's not too far from a realistic expectation. But at an absolute minimum, we would have to say, based upon a CPA accountant's analysis, this should be a $5 or $6 stock. So that's the target. So for my family office, when we hit somewhere above that, because I mean that's the lowball figures I've just indicated, but once this stock hits somewhere around the $7 or $8 range, if it should happen in the next year or so, maybe a year and a half, we would cash out of that position. We would liquidate the position once we got there, unless, of course, more acquisitions occurred, profits got even bigger, and the picture changed to the point where it looked like, well, maybe a more reasonable price target would be like $10 or $15, and then we would just sit back and hold that position until we got to what we thought was fair market value. But at some point, we're going to lose the majority of the retail traders, and we're going to get to a point of fair market value. And once we finally get to that point of fair market value, and the price doesn't look like it's going up too much more, and it's stabilized, well, obviously, any point in that time frame would be the proper place to liquidate the stock. Okay, so on the sort of market dynamic side, we're going to do more videos, and we're going to talk about market dynamics, because there are many issues that I've raised, which, sort of the common listener, there's just sort of the passerby general type of listener would have no idea exist. But there's a whole bunch of market issues in here, some plumbing issues. So, for example, one of them, we might ask, oh my gosh, how in the world could this stock with a fair market value somewhere in the $5 or $6, if not $8, $9, or $10, be trading for 47 cents? I mean, there's a huge disparity in there. So prices are set by supply and demand. It's very simple. If you got more buyers than sellers, the price is going up. You got more sellers than buyers, the price is going down. So the short-term price action issue is very different than the long-term investment issue. So when I look at my Bookmap trading platform right now, it's over here to my left. I've got Sundial up, and I can see the actual orders that are placed on NASDAQ, because Sundial trades on NASDAQ. And on my right here, I can look at the level 2 screen for Sundial, and this is what the market maker has put up. And when you look at these two data points, you would think that they would be the same, but they're not. And the reason why is, whereas the limit orders placed on NASDAQ, they're all there. It's all plain to see. Whereas with level 2, this is controlled by the market maker. Whether people realize it or not, the market maker puts up the bid price, and it puts up the ask price. And when you and I and all the other traders and investors in the world, if we put an order up to buy or sell, there's nothing that requires the market maker to put that full order on display and in the level 2 quotes. And very often they don't, because what they try to do is they try to put a percentage of the orders on the bid side, a percentage of each of the orders on the ask side, so it looks like one has a orderly, balanced market. Whereas in reality, when I look over here at Bookmap, which is telling me what is actually on the order book at NASDAQ or the New York Stock Exchange, if the stock is listed on the New York Stock Exchange, I can see exactly what is above. So when I look at Bookmap, for example, I see there are 15 million shares to be sold between the current price of 47.48 cents and 95 cents. Whereas when I look over here at level 2, you have no idea that that's what's happening. So remember what I said, one of the internal plumbing issues is, if you got more buy orders than sell orders, price is going up. If you got more sell orders than buy orders, price is going down. So when I look at Bookmap, I'm like, you know what? Look at all of those shares lined up to be sold. 15 million of them. So that's way more than the number of shares to be bought. And that's the problem. So we've got all these retail traders that have heard from Sundial's conference call and earning reports that if the stock price doesn't go above $1, and the reason why it has to go above $1 is because of the listing requirements of NASDAQ, which is the same as the New York Stock Exchange, then there has to be some substantial change in the company, or there has to be what's called a reverse stock split. We'll get into all those details later, but the only point I'm trying to make now is to say, well, look at this. This stock price is so much more valuable than its current price, but the reason why it can't get there is all of these meme stock traders are trying to get out of this position. No, there's no reason to get out of the position. It's not a very smart thing to do right now. In fact, it's like, in terms of your overall financial picture, it's the worst thing you could do right now. I mean, if anything, people should be building much bigger positions than they currently have. But that's, there's something called crowd psychology, and there's retail trader psychology, and there's trend trader psychology. All that stuff we'll talk about at another time. But I'm just kind of pointing out that there are a lot of issues in this short video that requires elaboration and elucidation, and we're going to get there, because I mean, if you're going to hang with me on this channel, then we're going to learn a lot, and we're going to learn how you really make money in the markets on Wall Street. Okay, so just as a note here, if you haven't subscribed to the channel, please subscribe. If you got some comments, put your comments in. I'd love for you to join the conversation. Okay, so going back here, from our road to the White House point of view, knowing what I know about the market, what would be some of my suggestions for reform? Because believe me, Wall Street needs reforming. There's no question about it. I mean, if we were living in a time where any Tom, Dick, or Harry, or Alice, Mary, or Sweetie couldn't just jump into the market as easily as they can today, then it wouldn't really matter. Back in the day when you had to trade in 100 share lots and you had to pay commissions, it pretty much kept little guys out of the market because the cost of entry was too high, and they had better things to do with their money. But we're living in a time now where Wall Street has gamified these platforms, which, by the way, we're going to go into great detail because it really is like NASA. My desk is like NASA. I've got so many indicators and so many data points and ways that those data points are presented that it would make any astronaut sort of lower their head in shame, because even NASA would have a problem doing what I've done. But it's pretty much all useless. But it looks good. But the basics are what's important. But what I'm saying is, when the markets are open to everybody, which of course they are, and a lot of people who don't know what they're doing jump into the market, their chance of losing money is very high. But more on that later. So the law reform suggestions that I would make here, number one, if the short-term trading community needs to be taxed, and taxed heavily, much different than the long-term trading community. Now, it already is. Okay, so just so you know, if you're a short-term trader, then whatever your tax rate is as a person, whatever bracket you're in, that's what you're going to pay on the gains that you make short-term trading. Whereas if you're a long-term trader, so basically it means you're holding your position for more than a year, then you're only going to pay 25% on your capital gains. Here's the problem that I have. When we look at stock prices, rarely, especially in the absence of a catalyst, there's no fundamental substantial reason to justify a price difference from second to second. Since we started this video, it's been 22 minutes. The stock price has changed a penny. There is nothing fundamentally about Sundial which would justify that penny change in price. What we're looking at is pure and simple price action. The stock's traded 61.3 million shares so far today, and this price reflects what other short-term traders are thinking about the market. But this is totally different than what Sundial is really worth and what its real value is. So I have a problem with the short-term traders because it really is a game. It really is a casino. What's happening today and every day is people are jumping in, they're buying at one price, they're hoping to sell it higher. If you buy 100,000 shares of Sundial, it's going to cost you $50,000 at the current price at the moment. If it goes up 1 penny with those 100,000 shares, you're going to make yourself $1,000. You're going to sell that, and you might do it 4, 5, 6 times throughout the day. Now, I've done that before. I hate to do it because the market can turn on you just like that, and there's no guarantee that the price is going to go one way or the other. And there are all kinds of indicators, like RSIs and Bollinger Bands and Keltner channels and moving averages, and we'll go through all this stuff in our videos. But the point is, really, when it boils down to its essence, you're guessing. And if you're guessing in the short-term trading world, that's a nice, polite way of saying, you're really gambling. And it doesn't matter what all the indicators are telling you. Many people fall into the trap of thinking that they've given themselves an edge, and more often than not, they've just got the trend right. And what they've done is they've gauged market psychology, the bull bear bias at that moment in time, and they were able to ride these many waves. Now, granted, the indicators and a whole bunch more that I haven't talked about will kind of give you a taste of the strength of that wave and the direction, and that's essentially the heart of technical trading. But if you step back from it for a moment, that is gambling. So that the short-term games, I would never encourage short-term trading, because the truth of the matter is 95% of retail traders lose. There's no question about it. It's a known statistic. I think that overall, when you talk about investing in short-term trading and swing trading, which is kind of in the middle, there's it's like 60% of traders lose 60% of their account in 60 days, and we're talking about retail traders. Now, on the other side of that coin, you have someone like Goldman Sachs, which an article came out today in the financial press that they've had more 100 million days profit in a row than they've had since 2011, and of course they're dealing with billions upon billions of dollars, and they've got a room full of hundreds and hundreds of traders, and they're trading all the financial markets. And they're mathematicians, they're scientists, they're extremely well versed, and then of course and they're going to have the computer hardware, and like I have, and they're going to be way more accurate with their entries and their exits, and they're all going to be very well educated. I mean, we're not talking about dummies. We're talking about folks from top schools. So you got the retail traders on one hand, short-term trading, which is really gambling because they just don't have the skills, they don't have the technology, they don't even have the account size. On the other hand, you got someone like Goldman Sachs, which is really just a vacuum cleaner sucking up money from the market. And then you have someone like Jim Simons, which is doing the same thing, but they're using computers, and they're in that trade for 8 seconds. They figured out what a million signals are in the market, and they're scooping up money. Now, is that any benefit to the companies on the stock market? No. Is that any benefit to society? No. Who is it benefiting? It's benefiting the traders, and then of course harming the wannabe traders. So if someone were to ask me, if we were in the White House, I would say to Congress, I'd say, look, we have to change the tax rate. We want to discourage short-term trading. There is no real value added to these financial instruments, and it's really creating more harm than good. So I mean, what would be a more suitable tax rate to discourage short-term trading? Something like 50% of all profits to be settled every single day, and you don't let losing trades offset winning trades. I mean, we really want to discourage this. I mean, the stock market has a legitimate purpose in society, but it can't really serve that purpose well if it's harming more people, and it's essentially a glorified gambling machine. So short-term trading is a problem. I would tax it just like we've talked about. Whereas investment, on the other hand, you want people, everybody should invest in the stock market, because if it's done properly, you find undervalued stocks, which is Sundial is now an investment stock. It's a hugely undervalued stock. It's whoever's buying in, and at the cents level, if they hold it until it gets the fair market value, they're going to increase their money 5, 10, 15, 20 times, and that's going to happen someplace in the next year or two. And on top of that, it's going to serve a much greater purpose. So pension funds will invest in the stock. Institutions will invest in the stocks. Families won't see their hard-earned monies dissipated or essentially lost, and the roulette wheel of the market. The issuer of the stock, Sundial, gains because they've got access to funding. In addition to that, they develop a shareholder base that's going to be with them for the life of the company. So the long-term, stable, solid group of folks in the stock, of course, are always much better than an army of retail traders who are trying to get that 1 penny profit. I joke with this stock. The reason why they're doing it is so they can go out and buy some more pot today, or go out and have a party tomorrow. I mean, of course, I don't really know if that's all true, but I'm sure some of them actually do that. So that's a headache. But now, going one step further, what are some other law reforms in relation to the stock market? Crypto, I cannot even believe that the Securities and Exchange Commission and the current powers to be even allowed this to happen. This is the biggest joke in financial history that anyone could possibly have come up with. Number one, there was nothing under crypto. Okay, there's no company, there's no stock, there's no earnings. This is nothing but a bet on crowd psychology. Don't listen to anything that these people say about alternative currencies. Yeah, no, it's never going to work. I mean, you can't possibly have a currency that fluctuates by $20,000 in the space of a couple of weeks. I mean, this is just absolutely nuts. One day the pizza costs you, $10, and the next day that pizza costs you $100,000. Oh, come on, this is absolutely nuts. There is no place in a rational, safe financial market for crypto, which is nothing but a bet on a crowd of people. Or another way to say this is, who's the bigger fool than I? If you buy in at 40,000, you're really hoping somebody else is going to come in and buy you out at 50,000. This is nuts. There's nothing there. What are you buying? It's like air. It's like hot air or cold air. It's just air. There's no value or substance there. The government can just simply, in one quick little one-page law, say no more cryptocurrency, and that's it. They go to zero, and all these folks that put their money in crypto will lose everything they have. So this is a major problem, and this is just another example of Warren Buffett's phrase the other day. The stock market becoming a gaming parlor. The gamification of the stock market. But we're going to get into more detail on Warren Buffett and his comments and trading style a couple of videos later. But in terms of reform, that's essentially what I want to say right now. We need to encourage long-term trading, discourage short-term trading, eliminate crypto, and of course, knowing what a company is doing and to know it in a timely fashion is extremely important. But I got to say that the laws around that last issue are pretty much they're well settled. And I mean, take one of the things I did as a lawyer is I was a securities lawyer, and so I went down and looked at this plumbing in great detail. So I know exactly where we progressed on that front, and it's that part of the financial law works really well. So there you go, folks. There's a quick introduction. What's the difference between trading and investing? I hope after you hear the video, you trade with the utmost caution, and you really focus on longer-term investments, which will make you a ton of money. So with that comment, subscribe to the channel. Let me know what your thoughts are. Join the conversation, and see you next time.